Hello and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. Before we get started, standard disclaimer, none of this is investing advice. Do your own due diligence. Today's guest is an investor who focuses on the commodities space and is the creator and host of the Finding Value Finance YouTube channel. Mr. Andy Hoese, welcome to the program.
Hey, thanks for having me on. I really appreciate it. So thanks for the invite. And yeah, let's get right into it. Excited.
Okay, I love that attitude. So I want to get started with your own journey in investing. How did you start investing, and what drew you to the commodity space in particular?
Well, what drew me to investing, I'm an engineer by trade. I went through college, got my engineering degree, started working as an engineer. And then what I noticed is that I wasn't necessarily happy with how much money I was making. So I wanted to figure out a way to make more money. And one of those ways is investing. So I kind of became obsessed with investing in my early 20s. Then I started reading all sorts of things. I started putting together, I guess, information for myself, doing my own research, looking at things from a different perspective than I would say most people, even from the books that I've read. And used my engineering background, basically morphed into ratios analysis on where to identify value, and then kind of just plunged into it with using logic versus maybe reading books and gathering information that way. So I did it myself using data or charting and all those different things. So I wanted to make more money and set up my life in a way where money's making money for me instead of me working for it. That's really the gist of all of it.
So I know you're bullish on commodities and you focus a lot on that on your channel. Lay out the thesis for us. Why do you think there's a commodities bull cycle on the horizon, or are we in one right now?
Yeah, so we're starting one right now. Yes, we are in it. So the thesis, what I use is, I call it three pillars. There's three pillars to investing that I look at the world through. I look at using ratios, which ratios tell you relative value. It's an asset priced against an asset compared to history. I don't know of a better way to discern value in the market than using ratios. So I look at all these different types of ratios. It's just an asset versus an asset. It could be real estate, stocks, bonds, commodities, whatever it is. You price those two against each other, and then you look at history. And when you do that, that will tell you what's cheap in relationship to history. Right now, commodities is very cheap. It is turning up against other assets. It is starting to outperform stocks, bonds, whatever you want to measure it against. So it's at a low valuation, it's turning positive, and money is coming into that sector. The other pillar, so that's the first pillar's ratios. The second pillar is market conditions. Market conditions are what causes money flows to rotate differently within those ratios. It's what is going to cause the money to flow differently? How is money going to be allocated to commodities versus stocks or bonds? What I've found is that inflationary liquidity pressures, so when you price, everything is priced in a ratio. Let's say it's oil priced in dollars. That's a ratio. It's an asset priced in something. When you look at these things, they can go up through two measures or two means. One is the supply demand balance, which is the numerator, the top portion, which is the asset related. Another portion is the denominator, which is the dollar that it's priced in. So when I look at the liquidity coming into the system, I have a whole kind of market condition analysis on that, which is the business cycle or real estate cycle. It's the same thing with liquidity coming into the system with that is inflationary or declining dollar, which is your denominator. We also have in the numerator supply, demand, and balances in a whole bunch of different commodities. So we've got two market conditions that are in alignment with the numerator, which is the supply demand characteristics, and we'll call it the commodity cycle, aligning with a short-term or shorter cycle of the business cycle, which is liquidity driven. Then you've got the credit cycle, which is a really long wave one, which is also aligning towards an end of a credit cycle, which deals with the money itself. So it's all these things overlaid together in alignment, which could set up for I'll call it a massive commodity super cycle. So that's the second pillar. And the third pillar is using technical analysis. Technical analysis validates basically all of those things that I was just saying, using data from the markets. So you can look at price data and you can say, look, is my analysis correct? Are we favorably changing from an undervalued state to and changing upward, and how do we validate that? You can just use basic trend lines, basic charting analysis to see the big picture view, and that technical analysis should marry up with the fundamentals. So everything is connected with what I just said. What you should see is money flowing between sectors. We can validate that through ratios and technical analysis. The market conditions should align with the ratios, which should also align with the technicals and how people are positioning in the markets. So once you have those three pillars, you can basically identify value, identify when the value will change, and then validate it using technical analysis. That's basically the three that I use.
So I want to focus on technical analysis a little bit because you use charts a lot on your channel. And for someone like me who's kind of lost when looking at charts or approaching it from a technical side, what's the benefit of approaching things using technical analysis? And what do you think are some of the things that someone who might be just getting started with that should focus on?
Big picture, what I would do if I was new is I take the big picture view and just ask yourself, is the big trend broken or not? Is it continuing to go down, or is it bottoming out, or are we starting to go higher? That's the big takeaway that I would use if you don't know any technical analysis. Is the stock making higher highs and higher lows? If it is, you're in an uptrend. That's the most basic thing that you can do. And the reason that we use, or the reason I use technical analysis, is because what I think doesn't necessarily matter. It depends on what everyone else thinks, and it depends on what the market data is telling you to think. So I can come up with a large thesis, and if it's incorrect, if the market disagrees with that thesis, I have to have a way to validate that I'm wrong or right. So the way that I validate everything that I've come up with, so basically, if you were to deconstruct what I created, I took charting and data and developed the thesis from the data backwards. Then I developed it and found leading indicators and saying, okay, if these, how can I determine where money is at and isn't? How can I determine where the value is in the market? How can I determine when this is going to change? And I used the data to basically come up with those three pillars in the thesis that I created for the entire channel and website. So it's a data-driven approach, which then focused on where could I look for leading indicators in the markets. And those leading indicators, to give investors, I'll call it an edge, are ratios and looking at the market conditions of money coming into and out of the markets. We'll call it inflation or deflation.
So I'd like to focus specifically on some different commodities now, and let's start with one that I'm personally bullish on. I have a lot of conviction in, and that is uranium. So how do you see the uranium space right now, and how do you see it developing moving forward?
So uranium on a ratio perspective is very good. And the reason that it's good is it's very low in relationship to other assets. So if you were to price uranium against, we'll call it gold, uranium is very cheap in relationship to gold, which means that you're getting a good value. Another thing that uranium is very good is it's highly leveraged to gold and other assets. So what that means is it swings very largely against other assets. It becomes very cheap and it can become very expensive. Those swings give you the largest opportunity for returns given anything else in the market in commodities. So it is the most volatile of the group. I also think that it's very good that the entire group last time did very well in that commodity boom: explorers, producers, and developers. So when you look at it, it has very good value. It has a lot of upside potential. And last bull market, the majority of the group performed very well. And almost everyone performed very well. So it's a high probability bet based off of history with a ton of upside potential, which is still very well valued. So uranium, I think, is one of the best areas to invest based off of ratio perspective and off of leverage for a commodity bull market. Another thing that is incredibly important is we are in an energy crisis. And if you look at an energy crisis, you can say, well, look, we've got oil that has market balance problems. We have natural gas that has, when I say market balance, supply demands are all jacked up. And uranium produces electricity. Natural gas is a competitor for uranium. So if natural gas were to explode in price, which we've seen already in Europe and over in Asia, I would assume that natural gas is going to explode here in the United States. So I've positioned heavily in natural gas. We're starting to see that price rise up here. And then uranium, I think, will be next. Uranium is going to be incredibly explosive and it's very volatile. So if you're a new investor and you're looking at investing in uranium, it can be a little bit difficult because of the price swings. It's very volatile. It moves up a lot, up and down. And you're going to have to be you're going to have to grow up fast if you hold these things and be able to stomach these large swings in uranium to enable to hold on. And eventually it will break out of this kind of up and down pattern and really take off. And when it takes off, that's when you'll be glad that you're in it. It's going to be a big move.
So what about oil and gas? You mentioned natural gas there, that you're positioned in that specifically for the potential of US prices going up very much like they did in Europe. Is there still opportunity now in the oil and gas sector for somebody who's just entering the space, or have all the big gains been made? What's your view?
I think there's still gains to be made, yes. I think that the oil companies are priced like oil's around $60, $70, $80. I don't think it's priced in $120. I think that we're breaking very large patterns technically in a lot of the companies where they have a lot of upside potential. And I think we're still early in the commodity bull market. And, a lot's going to depend on, I guess, India and China and how fast they adopt other technologies as well. And on how long this bull market will be. They're in the middle of their S curves in their adoption of energy growth. So I think we could have a long runway ahead of us in terms of value that's left ahead of us, and the potential that these oil and natural gas companies can go up. Natural gas in America, I think, has a long way to go higher. Oil, the ratio right now is about, I'd say, average. It's about a 1 to 15 to gold. So that's pretty average. An expensive price could maybe be a multiple of 1 to 6, but we could squeeze it all the way down to 1 to 3 or 4 or 5, somewhere in that range, which means that we could still, oil could still compress against gold even further. So there's still a lot of runway left value-wise for oil and natural gas. And, would I choose those companies over uranium at this time? Probably not, because uranium's got a long runway ahead of it and it's very explosive. So I would favor uranium, but I would definitely not sell anything in oil and natural gas. And if you have some opportunities there, I still would buy some. Yes.
I talk a lot about the monetary metals on this show, gold and silver, and I do want to talk about that with you. But first, I'm excited to talk about platinum and palladium because you're one of the few people that actually discusses it on a regular basis. So what's your view on those two metals? Where do you see them moving forward?
I'm a huge platinum bull. The reason I'm a platinum bull is because it is cheap against all of the other precious metals. It's cheap against all of the other assets in the world. It's probably the cheapest asset based off of how you measure it ratio-wise compared to history. What that means is that if someone's going to design something, and remember, I got an engineering background, if someone's going to design something, there's no way they would choose palladium over platinum. Platinum's cheaper. Right now, it is cheaper. Palladium is, I haven't looked recently. It's like 2,000 something dollars. Platinum's like $1,000, just roughly speaking. It's half the cost. And people like designers and myself would choose platinum over palladium. And that's how the markets work. So, and that's why the ratios work. Platinum, when you price it against other metals, is also favorably turning higher against those other metals. So it's gonna, I think, going to outperform silver, palladium, and platinum based not only on how low it is, but how it's moving against the other metals and how it's starting to break patterns to the upside. So I think that platinum is one of the best investment opportunities of any of the metals, and it's favorably reacting to the markets and breaking their downtrends and patterns to the upside. So, I mean, that's what you want to look for. You want to look for something that's low and is going and moving into, I call it moving into strength, which is strengthening, and its prices are strengthening and breaking downtrends and patterns.
So let's talk about the monetary metals, gold and silver. Do you view them like a lot of people do as inflation hedges, as a kind of a savings account outside of the system, or do you look at them as investments that you can actually make big gains on?
Yeah, so I view them as both. I view them as something that you can invest in and make money, or make purchasing power gains is the way that I would say it. And then I also view them as a way to diversify outside of the system, and a way to store wealth. So it's a combination of all that. Depending on where they are ratio wise against other assets, which they're cheap right now. They're cheap against the money supply. I'm specifically talking about gold. Gold's cheap in relationship to stocks. And I think where it is based off of those ratios, you can get purchasing power gains while being safer and out of the system and not having to speculate too much in terms of management and all these other things that you have to do, and taking on risk with businesses. You can kind of just completely de-risk, buy it when it's the cheapest it is against all these other assets, and just hold on to it for a period of time. They do very well under inflationary periods. The reason they do well under inflationary periods is because interest rates are going to start to rise. When interest rates rise, people who own bonds are selling their bonds. That's why interest rates rise. If they're selling bonds, they have to park their money somewhere. So we're just front running, I call it front running the money flows, where we're front running the money flow of bond investors who are selling their bonds, and they have to put it somewhere, and they usually put it in gold. That happens under inflationary environments. So yes, it's an inflationary hedge. Yes, it's a way to store your wealth or value outside the system to diversify out of that. And yes, it's very cheap and can create purchasing power gains against everything else. So I think that's a really good bet with the amount of risk that you're taking. It's probably the most favorable risk to reward bet because there's very low risk in buying these physical metals. Platinum is actually, I would say, the best inflation hedge based off history. And I think platinum will outperform gold during this next period or leg up.
It's not a commodity, but it's definitely involved in the commodities space. And this is a thing you talk about on your channel that, again, few other people do, and that's shipping companies. So could you lay out your thesis for shipping and why it makes an attractive investment at this point in time?
Yeah, so number one, the money is not in shipping. We're coming off a gigantic bear market in shipping. So we can see it in the ratios. The ratios also, if we were to go back and look at their performance previously in the ratios, we have large leverage in shipping against gold and other commodities. So it's another one that has a lot of leverage. Another thing is we have a commodity bull market that's coming, which means we need more commodities in this world. If we have an energy crisis, which we do have in fossil fuels, and we were to go to this new renewable world, the mineral intensity of these renewables are 6 times greater than the old fossil fuel world. So that's renewables are electric vehicles, wind turbines, and solar panels. So if you have 6 times the intensity, and it requires a lot more commodities, you're gonna have to ship these things around. So if we're gonna ship them around, and we are in a gigantic bear market in dry bulk shipping, I'm gonna specifically put dry bulk, even though it's across containers too. specifically in dry bulk, and you're going to increase your mineral intensity by 6 times during an energy crisis, which means they're going to try to ramp this up as fast as they possibly can. I think they're going to hit a constraint in shipping, and that constraint is going to be very well noticed at some point, where shipping rates are just going to rocket like no other. And historically, if we're at very low levels, meaning the money's not there yet, and if this were to play out like I think it might, you could see gigantic returns in shipping.
And what are the different ways to invest in shipping? Is there like a shipping ETF? Do you usually play individual stocks? How do you approach the sector?
Yeah, I usually play the individual stocks. There is an ETF. I think it's called BOAT, BOAT. It has a high expense ratio though, so I don't own anything in it because of the expense ratio. I just basically create my own ETF. I put some money in some of the larger companies, and I put money in some of the junior small companies and spread it out. A lot of the larger companies pay just massive dividends, all over 10% dividends in a lot of them. So you can get 3, 4 companies greater than 10% dividends, and then the juniors haven't really moved yet. So they're still scraping along the bottom, kind of basing out almost, I think, very close to a move higher within probably the next year or so, or maybe even sooner than that. But they're very low, and the big guys have already broken their patterns, starting to move on up. So I think that the momentum has already started. Money's already positioned in the larger companies, and I think eventually it'll work its way to the juniors.
So before we wrap up today, Andy, are there any other commodities you've had your eyes on that we haven't spoken of yet?
Yeah, I think I don't know a great way to play it, but I would say zinc, tin, and aluminum, and copper. Those are some really good ones. Some of them I don't know a great way to play, because aluminum is a lot of these they have to use a lot of energy. They're very energy intensive, but the pricing of those will go up. So if you play them directly, somehow to play the commodity directly, I think that there's a lot of potential there. Some of the companies, and I'll just say this in general, some of the companies that are mining companies may or may not do well, depending on what they do and how much energy inputs they have. If we're in an energy crisis and they're very energy intensive processes, we've seen in Europe some of these companies have problems, like smelting and stuff like that. So just be careful where you're looking and positioning in some of these companies, because if it's a high energy input during I'll say a high energy price world, I just think they may struggle, because you're playing the game of margins of that company, not necessarily the commodity price itself.
Yeah, that's awesome information. It's been great having you on the show, Andy. I love the way you approach things. It's different from a lot of people out there. I love how you compare commodities to each other. I find that very interesting. So for the viewers now who want to hear more from you, where's the best place to find your work?
Yeah, you can become a member on the Finding Value website. It's finding-value.com. You can become a membership there. It's a pay-for membership. You can go to my channel, that is Finding Value Finance on YouTube. So I've got a channel there. Or you can add me on Twitter. It's at finding_finance. And you can watch me there.
Great, and we'll put the links in the description below for anybody who wants to check those out. Thank you very much, and we'll have you on again in the future to continue the conversation.
Yeah, thank you for having me. I really appreciate it.
If you enjoyed my conversation with Andy Hoese, you won't want to miss my interview with investing legend Peter Grandich, where we talk about investing in a variety of sectors, including uranium, copper, gold, silver, and much more.